Welcome to Chapter 2 in our general accounting journey. We focused on the principle of get and give as we tried to analyze transactions. In Chapter 2, we are going to transition from get and give to debit and credit, and it will be hopefully a very smooth transition. So, here we go. Recall from chapter 1 that we defined accounting as a process of analyzing, classifying, recording, summarizing, and reporting. We are going to continue that process in chapter 2 with the analysis. Instead of using get and give, we will transition to debit and credit, and it will be a very smooth transition. So we still will begin with determining what did we get and what did we give, and then we're going to record the debit and credit. And again, the transition, as I said, is going to be very easy. Recall in chapter 1 that every transaction has a get and every transaction has a give, and the get and the give are recorded for the same value. We're going to continue that, as I said. So let's look at what we would have done in chapter 1 with each get and each give. My get I have classified using the color coding it blue, and the give is in green. So you can see when we were using one column that we showed increases and decreases with a plus and a minus sign respectively. So this 25,000 was a get of cash, and this 10,000 was a give of cash. And so the give decreased the get. So we would have had at this point a total of a balance of $15,000 in our cash. Then we had another get of 5,000 and another give of $3,000. And so at the end, when we net each get and give, we ended with $17,000 in our cash account. Similarly, on the liability side, if we had a give, we recorded it as a plus to accounts payable, and we had a get, we recorded it as a decrease in accounts payable, another give, we would have an increase in accounts payable, and we ended with a balance, the difference of $1,200. And so we are going to use the same principle of give and get, but we are going to layer it now with debit and credit. So how do we do that? Well, first of all, here is the good news. Every get is going to be recorded as a debit, and every give is going to be recorded as a credit. But I'm jumping ahead. What exactly does debit mean? Well, debit really means recording something, a dollar value, on the left side or left column of an account. And credit in accounting means to record something on the right side or right column of the account. And so we still need our get and our give, but notice a get is recorded on the left side just like a debit would, and a give is recorded on the right side just like a credit would. So we can walk away with the principle that every get will be debited and every give will be credited. So how do we apply that in when we move from one column, as we did in chapter 1, to two columns, as we are going to do in chapter 2? So when we use two columns, we will dedicate one column on the left for all our debits, because remember, debit means to record on the left, and we're going to dedicate the right column for all our credits. And the benefit here is we are then able to quickly see all the debit and all the credits. Whereas here I would have to go in and select each debit and each credit. But now we have all the debits on one side and all the credits on the other side. Notice also that I do not need to use the plus or minus sign because all the entries on this side are added and all the entries on this side are also added. The balance now in the account is the difference between the two columns, the debit column and the credit column. So here I had 30,000 total that was recorded on the left or the debit side, and I had 13,000 that was recorded on the right or on the credit side. And therefore, the difference between these two, the balance, the amount needed to make the two sides equal, is $17,000. Same thing happens with the accounts payable. We have a column on the left to record all the debits and a column on the right to record all the credits. Remember, a debit is made whenever we have a get, regardless of the account, and a give is recorded on the right, regardless of the account. So now we have all the credits on one side and all the debits on the other side. We add each of these debits, we get a total. We add each of these credits, we get a total. The balance, the amount needed to make the two sides equal, is the balance, the difference. And so since the credit side is larger, this balance goes on the credit. And so we can take away another important point, and that is the balance in an account is described based on the side that is larger. So this would be referred to as a credit balance because the credit total is larger than the debit total. On the other hand, this would be regarded as a debit balance because the debit total is larger than the credit total. So we really have two types of balances that will result with each account. We will either have a debit balance, which means that the total on the left, the total debits, exceed the total on the right or the credit, and so that would be a debit balance. Well, there are some accounts that it is normal to have more debits, as in the total dollar value, than credits. And those are assets and expenses. And so normally the debit side would be larger than the credit side, not in terms of the number of entries, but the total dollar amount. And so your assets and expenses are said to have debit balances because it's normal for the debit side to be larger than the credit side. Similarly, we have credit balances whenever the credit totals exceed the debit total in a given account. Well, it's normal for that to happen with accounts that are in the liability, equity, and revenue category. And you're saying, well, why is that normal? Well, if you think about the get and give idea, normally whenever we have a get, it's usually the result of an asset or an expense, for example. So when you get cash, it's normal. So we would normally expect that our cash account in our books will have a debit balance. Now, does it mean that your cash account, which is an asset, would not ever have a credit balance? Yes, it can happen, but it would not be the normal situation because if the cash account has a credit balance in your books, the owner of the account, then it would mean that you had more give than you had get, which means you had more credits than debits, and so you would actually be owing the bank because you overdrew your account. So again, the normal balance for assets and expenses will be referred to as a debit because it's normal for the debit side, the left side, to be greater than the credit side. And for liability, equity, and revenue, it is normal for the credit side to be larger than the debit side. In case you are wondering why DR is used as the abbreviation for debit and CR is used as the abbreviation for credit, without going into too much detail, just recall that this is actually the abbreviation for debtor, DEBTOR, and this is the abbreviation for creditors, CREDITOR. In any case, DR is the abbreviation for debit, and so assets and expenses, whenever you record an entry on the left, you are increasing those accounts. But if you were to record a give, which would be a credit or an entry on the right, you are decreasing the account. Similarly, for liability, equity, and revenue, whenever you record a get, which would be a debit, an entry on the left, you are decreasing the account, whereas if you record a give or a credit, which is on the right, you are increasing the account. Again, you can see that from this example. So if I were to record another credit here, then it would increase this from 1200 to, let's say, another 300. It would be 1500. On the other hand, if I did a credit here for the cash, it would decrease this. If I made a credit for 300, it would decrease this from 17,000 to $16,700. Because the categories of accounts are expected to have certain balances as the normal balance. For example, assets and expenses are expected to have a debit balance. The way you describe the account is going to be based on what is the norm. What do I mean by that? Well, as I told you earlier, assets and expenses, they normally have more on the debit side than on the credit side, so they are said to have a debit balance. So here is the cash account, which is an asset. And let's say I recorded $300 as a credit, an entry on the right side. And let's assume that that was incorrect, right? So this entry is incorrect. The way I would describe this is that the debit is understated because this would bring it down to $16,700, which is less than what it should be. And so we would say that the debit is understated. Let's come over here to accounts payable. The normal balance for this is a credit, which means it's normal for the credit side to be larger than the debit side. So if I made a credit entry, and let's say this is incorrect, let's say it should not have been there, then how I describe the error is going to be different. Same thing as I did over here where I made an erroneous credit, but this time it's being made in an account that would normally have a credit balance. And so what I would say then is that the credit balance is overstated. Why do I say overstated? Because when I make this additional credit, it will increase this balance of 1200 to 1500. And so the balance is now overstated. So please note the way that you describe the impact of an entry is dependent on what the normal balance is for that particular account. Now that we have the fundamentals under our belt. We know that every transaction will have a get and a give, and that we always debit the get and credit the give. We can go through our transactions, determine the get and the give for each, and therefore we will know whether we should debit or credit. And so here is problem 2.3b, and we are going to be looking at this transaction or these transactions from the point of view of the Johnston Clinic. Not from the point of view of D. Johnston, but from the Johnston Clinic's perspective. And so for each transaction, the question is, what did the business get? What did the business give? We're not concerned about Johnston. We're not concerned about the bank. We are looking at this exclusively from the perspective of Johnston Clinic. So the first transaction, again, we're still using lettered transactions as opposed to dates, but appreciate that these would all have occurred on specific dates. And these transactions are all occurring in the month of July of this year. So the first one we have here is where Johnston, the owner, deposited $35,000 in a bank account in the name of the business. So what did the business get? The business would have a get of $25,000, $35,000 in cash. What did the business give? They gave Johnston a claim on the business equal to $35,000. And so since we know that every get is going to be debited and every give is going to be credited and the amounts need to be equal, we would also know how to record the journal entries. So I am recommending that you go through each transaction, determine the get and the give, and once you do, then you know that each get is going to be placed on the left of the account that is involved, and each give is going to be on the credit or right side of the account that's involved. And the business has provided us with a list of the accounts that we should use. This would be called a chart of accounts. And so all the transactions will need to fit into each of these categories. So we select from the list accordingly. So for the first one, we would use the cash because the business had a get of cash, and we would use the equity, which is the D. Johnston Capital account, to record that transaction. Then we go down to where the business, remember from chapter 1, by the way, that this would be an example of a financing activity. And then we have where the business bought uh, assets, and they bought it on account from this company for $5,560, sorry. And so what did the business get? The business had a get of the chairs and carpet. Sorry, it's B. So they had a get of the $560, and they gave a promise. That's what the business gave. So we had a give of a promise to pay in the future the amount. So again, go through each of these transactions, determine the get and the give, and you would then record the transactions in the account. So let's take a look at how each of these would be recorded. Let's start with the first one. We had a get of $35,000 and we had a give of the same amount. And so we would go into the accounts and we look for the cash. Notice now that we don't have just one column, we have two columns, one for each time we have a get and one column for each time we have a give, and the difference between the get and the give will be the balance in the account. So here I am going to keep track by labeling each of these. So this A is for transaction A, get of 35, And here is the capital account. It has a give for 35. So again, the only thing that's changing, instead of having a column and we do increases and decreases, we now have two columns, one column for increases and one column for decreases. Specifically, or more accurately, we have one column for a get, which is a debit, and one column for a give, which is a credit. And it's normal for some accounts to have a larger total get, assets, and expenses fall in that category, and it's normal for liability accounts, equity accounts, and your revenue account to have more on the give side than on the get side. So the normal balance for this revenue account here is professional fees. And notice that since it doesn't have the word expense at the end of the name, we know it's a revenue account. If it were an expense account, it would say professional fees expense. Whereas for all of the each of the expense accounts, notice that the word expense is normally at the end of the account. So each account has a get for the expenses, because you will either get an expense because someone provided you with their services, the business that is. So, for example, when the utility company provides the service to the business, from the business perspective, the get is the service. When they use the services of the building, they have a get. When they use the services of their employees, they have a get. So that's why it's normal for expenses to have the entry be on the left or debit side, and so it's said to have a normal debit balance. Same thing for assets. We expect to see more on the left or debit side, and so the normal balance for each of these assets would be a debit. Again, it's possible for the credit side of your cash account to be larger, but that would mean that you gave more than you had, and so your account would be overdrawn. Look at these two accounts. They both belong in the equity category, the capital and the drawings. And notice that unlike the capital, this equity account actually has a debit balance, right? Because the debit side is larger than the credit side. But that's because we are using this drawing account as a temporary account related to capital. And so rather than put this as a direct decrease to the capital, we put it temporarily in this account, and then we're going to take the total from here and subtract it from the capital. But if you think about it, this debit, which would be on the opposite side of this credit, is going to decrease. So bottom line, that for every account, what happens on one side is going to have the opposite effect on the other side. But because we tend to have more of a particular entry for certain accounts, we regard it as normal for more debits to be made than credits. But just like the asset account, every time I make a debit here, it's going to offset the credits. Same thing happens here. Every time I make a credit, it's going to offset the debit. Or if I make a debit, it's going to impact the credit. So the bottom line is we have one side to record each get and one side to record each give, and the difference is the balance. And it's normal for assets and expenses to have more on the debit side, the get side, than on the give side, which is the credit side. And so the normal balance for those two categories is a debit. It's normal for us to have more on the give side for liability, for revenue, and for equity. And so the normal balance for those is a credit. So we would have recorded all of our transactions. And now we want to ensure that we did this correctly. And so we're going to do a test of the entries that we have made. One of the tools that is used in accounting to test the accuracy of the entries that have been made is called a trial balance. It's an internal report. This is not provided to any outside entity. It's used by the bookkeeper or the accountant to test the accuracy of the entries that have been made. So it's a trial, a test of the balances. So we take all the balances from the accounts that we have, and if the debit side was larger than the credit side, which means we have a debit balance, we put the amount, the balance in the debit column of the trial balance. But before I jump into the details, let me just point out to you that every time a report is being prepared, it needs to conform to some basics. One of those requirements is with regards to the heading. 3 questions should be answered: the who, what, and when. So we would need to be sure that the name of the business or whichever entity that we're reporting on is there. The title of the report needs to be there, and the date. Notice that it simply says July 31st because on this particular day, these were the balances. If we did it again in August, we may have different numbers, but on this specific date, July 31st, these were the balances. And it's normal to list the balances in a particular order. Assets are usually listed first, followed by liabilities, followed by equity, followed by revenue, and then finally expenses. It doesn't mean that you did something wrong if you did not conform to this order, but this is the sequence that is expected. So if another bookkeeper or accountant picked up a trial balance, automatically they would expect to see all of your assets listed first, then your liability accounts, then your equity, then revenue, then expenses. And so you see, I literally took the balances. So if we went back and looked at our cash account, you would see that that is the balance at the end of the month. And so that goes into our trial balance. Same thing is true for accounts receivable. This is the balance, and it's a debit balance because the debit side, the get, was larger than the credit side, the give. And so the difference of 315 goes here. And the same thing for our office equipment, office furniture, and then we have our liability. We have one liability account, then we have our 2 equity accounts. Notice that one has a debit balance, the capital, and the other one has a debit balance, the drawing account. Then we have our revenue, which we expect to show more on the give side or the credit side. And then we have our expenses, which normally have more on the debit side than the credit side. And so these normally have debit balances. And so consistent with what we have been doing, notice that your total get is equal to your total give. And so we have tried the balances and they are equal. And so now we can move on to the next phase of the accounting process, which is to summarize the transactions in the form of financial statements. The first financial statement that is normally prepared at the end of a period is the income statement. This is the financial report that summarizes the financial performance of an economic entity, in this case, Johnson's Johnston's Clinic for the month of July. Notice that whereas the trial balance was on July 31st, this is saying that it's for a period. This is for the month. If it were for a year, it would say that. So your income statement is summarizing the business's financial performance over a period, in this case 1 month, whereas the trial balance was giving us the balances on a specific date. So again, who, the name of the business, what, the name of the report, it's the income statement, and the when would be the date. So this is for month ending or ended July 31st. So we show the revenue, which we would have had in our trial balance. You can see the revenue there. So we put that into a separate column. And by the way, we're not recording transactions at this point. So even though we may have debits and credits, we don't need to do that when it comes to the financial reports. They are simply categorizing things based on the convenience of being able to manipulate the information. So this is my revenue. These are my expenses that I'm going to be adding, and then the total is going to be subtracted from the revenue in order to get to the net income. So revenue minus expenses equals net profit or net income. When you are entering your information in the income statement, simply record the absolute values of these amounts. Do not record them as negative because the template is set up, as you can see the formula here, it is set up to take this total and subtract it from this total to give you your net income or net loss. So you don't need to record these as negatives, just record them as positive values. They get added, and then the total will be subtracted from the revenue. And since we have more revenue than expenses, we have a net profit or net income for the month of July. Well, Johnston's Clinic does. We will then take that information and use it in the next financial report, which is the statement of owner's equity. This is the financial report that shows us what happened to the owner's equity over a period, in this case, the month of July. What did we have at the beginning? What added to it? What subtracted from it? So notice that we have a 0 here because we are assuming that on July 1st, there was nothing as far as capital because the investment by the owner took place other than on the 1st of July. But if it did, then we could have had this as the beginning balance. But in any case, we're saying it's 0, and then the 35,000 would be an investment during the month. Then we add the profit and we subtract the withdrawal or the drawings, and this is our net. So please note that what really will ultimately increase the equity of the owner of a business is revenue, and what decreases it are the expenses. And of course, if you have more revenue than expenses, it means that you have a profit, and so that profit is going to add to the investment made by the owner. So the owner invested 35,000, the business earned a profit of 1,035, so that adds to the investment of the owner. Then we deduct the amount taken out by the owner for personal use, called drawings, and we end up with a net added to the beginning balance of 0. We have our new equity for the owner of 34,835. Pay attention to this balance because when we get to the final report, we're going to be needing to use it. So notice, first of all, as I said, that the main thing that will impact the capital or equity of the owner is the profit. So if you would like to increase your equity, you need to generate a profit. It could be the difference between your salary and your expenses. If you have more expenses than salary, then your equity will go up. So practical application there for us. The third financial report that we're going to be focusing on at this point in the course is the balance sheet. So the balance sheet is a financial report that summarizes the financial position of the business on a specific date. So whereas the income statement summarized the financial performance over a period, this is going to tell us the financial position on a specific date. What did the business own? Assets. What did the business owe? Liabilities. And what is the claim that the owner has on the business? So those are the three main things that will be entered in a balance sheet. Again, like the other reports, the who, the what, and the when. So we have the name of the business, the name of the report, and the date. Notice that the date is July 31st, not month ended, because this is not over a period of time. If you were to ask me how much money do you have, I will tell you how much I have right now, not how much I had over the month. So we're listing the assets on this particular day. So a total cash of $33,185, receivable, and we know the difference between a receivable and a payable. From the perspective of the business, a receivable represents amounts to be received by the business, whereas a payable is amounts to be paid by the business. So you have to know the perspective from which you are looking at these amounts. The other thing too is the balance sheet is a summary. So you didn't have to list each asset account like this. We could have combined office equipment and office furniture and just showed the total of 2,045. However, if it's important for the reader to know that there are different types of fixed assets, then they would be broken out like this. My point is that the balance sheet is a summary of assets. It doesn't mean that if you have 10 accounts, you're going to see 10 line items in the balance sheet. They could have had more than one cash account, for example. They could have had a checking account and a savings account. We would have combined the two and just showed one amount as cash. So it's a summary, not a detail like you would see in the trial balance. But in any case, this is our total for all the assets. Then we need to see what the liabilities are. And again, these are coming now from the trial balance that we prepared at the very beginning. And so accounts payable, amounts to be paid by the business, $710 as of July 31st. And then we have the owner's equity, $34,835. Recall that this is the amount that is taken from the ending balance in the statement of owner's equity. This is so important. So many individuals get to the balance sheet and they struggle because they are using the beginning amount of the capital and not the amount at the end of July in this case. So at the end of July, what was the owner's equity? $34,835. And so when you get to the balance sheet, you must use the balance for equity or capital at the end of July, which is the $34,835. Notice, finally, requirement for the balance sheet, it needs to be balanced. And we know it's balanced when the assets on one side equal the sum of the liability plus equity on the other side. So if you think of this as a scale, assets would be on one side of the scale, liability and equity would be on the other side, and you would therefore see the equality. But even if we didn't use the statement form, but we use this columnar format, you can still see that this total assets equals total liability plus total equity. And so we know that our balance sheet is in balance. I'd like to end chapter 2 with a practical application of debits and credits. This is a hypothetical or fictitious bank statement, but this is a report that would have been prepared by a bank, and they use columns, one column for deposits and one column for withdrawal. Notice that I have the deposits as credit and the withdrawal as a debit, whereas in my cash account, it is the opposite. And this is where people say, well, you accountants, you do things the opposite way. No, it's the same concept. These amounts that are deposited, this would be a give from the bank's perspective, and each withdrawal would be a get. So let's think about it. First of all, when you open an account with a bank, the amount that you put in your bank account, the bank owes that to you. So it's a liability. So just like accounts payable, where credits will increase and debits will decrease, the same thing happens here. So from the bank's perspective, every time you make a deposit to your bank account, they are going to credit your bank account because they're recording it from their perspective. So you can see here that the credit would be an increase because we are depositing funds, and the debit would be a decrease from the bank's perspective, and the difference between the two would be the balance in the account. And since the deposits exceed the withdrawals, this amount is a credit balance indicating that the bank owes this amount to the customer. Please contact me if you have any questions regarding any information shared in this chapter 2 video.